Presentation here. Can everybody hear me okay? Yeah? Presentation here is called How to Develop Real Estate That Builds Wealth and Creates Impact. I've been on this kind of journey over the past 10 years, I'd say, on finding something that I can really invest my energy into that not only makes me money, but also creates massive impact in the world. Real estate is something that I've found can really have an important impact for a large number of people. So, is it me or is the sound going in and out? Yeah? As I turn. I just have to turn my whole body at the same time. Thank you for the food, by the way, Bo.
Yeah, feed you means you guys got to give me some love.
Yeah, for sure.
Or love, I can tell you about.
Well, all right, so the goal tonight is to both open your eyes to how to build wealth and create impact with real estate development as opposed to just real estate investment. For beginners, I'm going to help you understand how to identify and secure development opportunities as opposed to the renovation opportunities that most of us are a little bit more familiar with and are a little bit more obvious. For those of you who are more experienced, I'm going to help you gain clarity on how to scale your impact and to leverage your efforts by pursuing development opportunities. Because what I've found is that really the only way to create exponential value in this business is to create something from nothing. And you do that through taking advantage of development opportunities, especially in the early on phase. So, and I'll explain more of what that means. Okay, so as I just said, I'll reiterate it again because it's really the one thing I want you to take away from this presentation is that the only way to create value in this business and leverage your efforts is through development opportunities. The ability to actually take a piece of property from A to B or from B to C. And this development process that's defined here, land entitlement, building construction, and property operation, is basically the process that every piece of real estate, every piece of commercial real estate has gone through at some point of its life cycle. Right? So as a developer, your role is essentially to move from A to B or from B to C. Okay? So essentially you get a raw piece of land and you secure the entitlements and sell the entitlement. Or you buy the entitlement, and an entitlement is essentially another word for the development rights. The rights from the city to build that project. So once you build that vision and the approval, or once you buy that approval, you can then build the built building and then eventually operate the building as a income producing property. This whole presentation is really focused on commercial real estate. So the commercial real estate, in my mind, is income producing property and developing it from, again, nothing to something. Really the focus is this first phase, A to B. Now, the type of development that I'm encouraging people to pursue has particular characteristics to it. So again, the company is called Smart Growth. Smart Growth Inc. is the name of the company. Really the name of a larger movement that's happening in the world. Basically, there's a refocus on developing cities. Right? So taking the existing land that's already been allocated to cities and helping infill those pieces of land that are underutilized currently. There's a lot of opportunity to create massive value because most of the time that land is zoned for higher density, meaning you can get additional units on that piece of land. So there's a lot of opportunity within the city and jurisdiction itself. 2, transit-oriented, so the ability to actually develop property very close to transit corridors. So ideally a quarter mile within a fixed rail station. Again, the whole concept is people want to be able to have the option of walking or biking to, these sort of transit hubs to be able to move about without a dependence on an automobile. 3, mixed-use developments. The idea that you can work, live, and play in the same place. That sense of mixed-use, lively neighborhoods and buildings again, creates a sense of vibrancy that is attractive for people to actually want to get into real estate or basically rent space in that real estate that you develop. And then 4, the concept of zero energy buildings, the ability to actually develop property that generates enough resources for it to consume, essentially so that they're closed loop systems. So these are kind of the core principles behind smart growth and the type of development that we pursue. Now, I'm going to help really ground these principles in real projects that I've been pursuing. First, this notion of smart growth, it's an academic term, but it's also, in reality, what is more valuable in the marketplace today, especially for millennials. So it's in direct composition to suburban sprawl. So this idea that we should move out of the cities and move away and have less density, where we can have more open space. This has kind of been the paradigm, especially over the last 50 or some odd years after World War II, especially. This has been kind of the mandate overall. Now, as I've been describing, smart growth is the idea that we're going to be building up rather than out, creating better, more appropriate cities to, again, create that sense of liveliness and have people enjoy their lifestyles more often connected with their environment and with people.
Chris, is it okay to take photographs of your time?
Yeah, that's fine. This slide here essentially elaborates on the development process that I defined in the earlier slide. In my mind, I've called this essentially the roadmap for creating value in real estate. Again, when I talk about creating value, I'm actually talking about creating from nothing, fundamentally moving a piece of property into a different phase of its life cycle, right? So that could mean, again, a raw piece of land that you get approved as a project that you can then build or sell that entitlement, or taking an existing piece of property and converting its use, basically taking a commercial building and converting it into a mixed building like the one that Aaron and I are currently pursuing, or actually taking a property and just incrementally improving it by way of its cash flow. So a value add strategy of an income producing property would be more aligned with this current phase. It's an existing income property that you're just incrementally improving versus transforming a piece of property. Again, raw piece of land into an envisioned building that can then actually get built out. So there's a lot on this slide, but essentially we're looking for assets that can be moved through this development process and taking on projects with those assets. So for example, with A to B, I'm essentially looking for land that can support higher density. So the ability to add units to that piece of land by going through the city approval process. And that adding density is the value that's being created that can be passed on and sold to the next developer. So in my mind, when I started opening up to it was basically getting new units on the board. Those are essentially the points in this game of real estate. So as a developer, I'm looking for ways to add units. And if the more units that I add, the more value I'm creating, the more money I'm going to make. Again, the type of units that I'm looking to add are aligned with smart growth, but that's essentially the gist. The development process is really development agnostic. You could deploy these strategies anywhere. Again, I'm just right now encouraging a particular type of development. So again, there's acquisition points and there's exit points along this development process. And there's a multitude of different strategies, with buying a piece of land and selling the entitlement being just one of those strategies. But ideally, and the holy grail of real estate in my mind, is to actually buy a piece of raw land, envision a built building and get the approvals, then construct the building, and then operate the building and refinance and hold the asset. So essentially what you can do along the way is continue to roll over the value that you create, such that by the end of this process, you've created enough value where you can potentially refinance out your total cost to get there and essentially be left with an asset that you hold with none of the original cash in the deal originally. Again, you can only really do that if you can put a permanent loan in place at the end of it such that is equal to or greater than your total cost. And by navigating this entire process, most of the time you should be able to get there and essentially increase your balance sheet, right, from the equity that you're retaining, and increase your profit and loss statement, your personal cash flow, because you're left with basically a cash flowing asset at the end of this whole process. So not only do you get to keep the equity, you get the cash flow, and to boot, you don't pay taxes on any of that, right? So a lot of what happens in this whole process is at these exit points you have a tax implication. And for many fix and flippers in the room, you know that short-term capital gains on those fix and flips are somewhere around 45%, a tax rate. So you make all that money and then you pay it all back to the government. Long-term capital gains, which a lot of the times entitlements can be, is only a 15% long-term capital gain treatment. You're keeping a lot more of your money. But again, the holy grail is that you can get all the way to the end of this thing, refinance it, and potentially pull cash out tax-free and retain the asset and all the income in perpetuity. So that's the name of the game in my mind, is finding opportunities here that you can continue to roll over value along the way. Now the time frames tend to be a little bit longer, but again, I'm constantly contemplating this roadmap. So if there's if there was two things that you were to take away from this presentation, it's understanding the game that you're in, which is real estate, and ideally you understand that development is this whole process, and there's a multitude of strategies along this chain. All right, so let's ground this into a real life example of a project that I just sold last year, which was a mixed use entitlement. Essentially, this property was listed on the market for $1.325 million in Oakland, about 2 blocks from the MacArthur BART station. It was a 12,000 square foot site. It was a former gas station that was being operated by a tire shop, a taco truck, and a car wash. It was messy. There was nothing there really to get excited about. But I knew that the zoning allowed for higher density. So this site allowed for 33 residential units by right. According to the zoning code, you could add 33 units to this site within the current rules of the zoning code. So essentially, I structured a partnership to acquire the site. We got hard money to close on the deal, and essentially secured the entitlements for a 6-story building, not 33 units, but 41 units, because we evoked a state bonus density law that allows you to get higher density compared to the current zoning if you add a certain number of affordable housing units on site. So by basically running the analysis here, going up to 41 units, the yield on cost, which I'll talk about more, was much more attractive than the 33 units. So we were basically able to sell the 41 units to a developer outside of the city who was willing to pay us $85,000 per door of entitled land. So this is what the site looked like when we sold it, right? We didn't touch the land, but I navigated the process to get the approvals and was able to sell it for 41 times 85. So I'll show those numbers in a little bit more detail, but essentially this project type, I was able to set a vision in place and hire an architect to basically factor in all of the key principles, the design criteria that I was telling them that I really wanted to see in line with smart growth. Again, within a quarter mile of fixed rail, ground floor retail, so again, mixed use development, housing units above the retail, open space on top of the rooftop, a massive solar array on top of the building that would be able to generate enough renewable energy to power the whole building, an EV chargers, electric vehicle chargers, and a car share that was connected to the solar array on top of the building, minimal parking, given the fact that it's just 2 blocks to the BART station, and bike storage and other amenities. So, I didn't have to build this thing, but I could set the vision in place because I was the one who was up front putting a vision out there to say, this is the kind of development that we need, and we got paid handsomely for it. So as you can see here, it basically was a deal that took 18 months so a little bit longer than you guys are probably used to, but we bought it for 1.325 million. Our total cost all in was 1.95, and we sold it for 3.5. So we made $1.5 million total profit on the deal in 18 months. Not touching the land, simply selling the development rights for that site to another developer out of state. Or actually, they were out of the area, not out of state. That developer actually is an affordable housing developer. So they bought the land for 3.485. They're now actually going to build 100% affordable housing on that site. So not only was I able to tee up a project that was designed to be net zero energy, right, achieving some environmental goals, but the social goals of adding affordable housing to a marketplace that desperately needs it and coming away with a strong financial return. Again, this was a triple bottom line type of investment opportunity. Yeah, so we structured a partnership with a complicated split. So that wasn't all to me. This was also to my partners. But this was a really good opportunity. Okay, so a little bit of who I am. Again, my name is Chris Porto. I'm the founder and CEO of Smart Growth, Inc., a real estate development and investment company. As Bo mentioned, I was previously with a solar energy development company called SunPower, and before that was with Deloitte Consulting, focused on sustainability and climate change. So I've been in this sort of sustainability or sustainable development field for my whole career. I've since joined the Urban Land Institute, which, if you're not familiar with ULI, it's the Global Association for Real Estate Developers. They have some of the best academic training. They write all the textbooks on real estate development. I went through their professional certificate program to get have a focus in real estate development. I also went through Fortune Builders, which is really how I first got started in real estate. Basically figuring out a way to actually make money in this business. But when I joined Fortune Builders, I had no idea. This was about 4 years ago. So 4 years ago, I had never done a deal. I had no idea what it took to actually make money in real estate. And I used that opportunity to actually figure out that, look, I could just buy a single family home, improve it, and sell it. But nowhere along that journey, and I soaked up every piece of information that those guys had to offer and traveled around the country with Stuart and others to go to all their boot camps. But I had no idea that the whole development process was so wide, and there were so many other strategies in the real estate world to create value. So I had to kind of learn that for myself. I have a finance degree from Virginia Tech too. Okay, so my evolution as a... Okay, sorry. So I did live in Japan for a number of years. I grew up learning Japanese in Virginia. I lived there. I lived in a dojo after college. I earned my black belt in Aikido, and I'm now up for my 3rd degree black belt that I'm coming up on in September. So lots of side stories. Thank you. So yeah, I've been doing Aikido for about 10 years. Thank you for the call out there. Okay, so my evolution as a developer. I left SunPower with 5 fix and flips on my plate, and I said I can't manage these large-scale commercial solar development projects. I was raising capital for those projects. So I was doing project finance where I was raising money, doing the financial modeling. Again, but I felt called to do real estate that was more of an integrated asset that could have a social function to it as well, powered by solar. During that process of flipping, I started to understand what zoning was all about. And nobody taught me about zoning. I didn't even know what zoning was until I was starting to try and add some square footage here and there. I wanted to make some expansions, only to realize that zoning was the rules of the game, right? So if you're in real estate and you don't know what zoning, the function of zoning is, that's the big opportunity that I'm going to open your eyes to tonight, because zoning creates opportunity. It basically defines the potential of what you can go after in order to then actually build that structure. You have to navigate the zoning process before you can actually build a building. As I said, I then joined ULI to understand how to become a small-scale developer, and navigated that process, started to then look for opportunities to entitle sites. And as I was networking throughout the industry, people were opening my eyes to the fact that I could go after a development opportunity, secure the entitlements, and then sell it for a large amount of money. and realizing that that was a really legitimate strategy, I started acquiring these properties, 3 of which I exited last year, and we'll go into those in this presentation. So my track record in general, you can see I've kind of split this up into 3 chapters. Chapter 1 was fix and flips. Chapter 2 was entitlements and sell, or secure the entitlements and sell them. And you can see the unit count starts to increase pretty quickly. Where in the last 18 months, I've got about 50 units added to the Oakland housing market. And then now I'm acquiring sites, taking it through the entitlement process, building it out, and then holding it. So I'm kind of proving out the model when it comes to creating enough value to hold the assets long term after you've navigated the process. And I'll talk about this deal later in the presentation here. So one thing that I was not told is that there's a whole deal trajectory that you can go through, right? Where you can start with assignment deals where you get these properties under contract and you pass them on to other developer investors, take minor renovation projects, or move into something like entitlements or subdivisions, which are a little bit more complicated, essentially, as opposed to just adding units. And then moving into construction, which quite frankly is a little bit harder to navigate compared to existing renovation side. And then converting assets, and as Aaron knows, converting assets that are more complicated to navigate around because there's constraints there, and fundamentally changing it from one use type to another can be a pretty daunting process. And then the larger opportunity is to do a whole master plan development that you see in a lot of areas. Okay, so probably like you, I was taught to buy a property like a single-family home or a multifamily property and just incrementally improve it, and to get through the planning and approval process as quick as I possibly can, because there's value to be created in the construction process. But what I've learned is that you actually create much more value in the entitlement process, and you only really solidify the value that you've created in the entitlement process in the construction phase. So to think about entitlements as the offense, where you're going after value, and then the construction is more as the defense, right? You're actually defending your original assumptions, is one way that I've to learn this whole process. And so again, the only way that I've found to create exponential or transformative value in real estate is to be a developer and to pursue development opportunities to move it throughout the process.
So Chris, this sounds great. Buy a property for $1 million to sell it for $3 million. So how do you secure that property? Are you writing a contract that's assignable? Because having to come up with $1 million and then entitlements can cost you tens, if not hundreds of thousands of dollars.
Yep.
So how do you recommend financing that whole acquisition?
Perfect. So tonight I'm going to go through a 5-step process that I go through every single time to essentially navigate what seems to be a complicated process, but I'm breaking it down very cleanly into 5 simple steps, okay? So first and foremost, you have to source development opportunities. You have to find them, right? So I'm going to teach you guys what a development opportunity is, and then how to just identify it. Say, that's it, that's one, that's one. Then you have to analyze the development potential, right? You have to know what goes into the calculation to basically say that has a lot of financial potential, financial impact. Then securing the development deals, right, with assignable contracts, for example, just like you do in the fix and flip world, all of the principles apply. But there's other creative ways to create the value without actually having to close on the land, which is arguably the most powerful strategy. I'll talk about that. Then financing the development projects, because a lot of the time these sort of deals are higher risk to lenders, and they'll only give you a certain amount of leverage. So like on our development deal, on 50% leverage. So understanding how to structure deals with equity is really the important differentiator here, to understand how to actually still do a deal when you're only getting a certain leverage. And then managing the process, right? Because you can start a project, but if you don't finish it and if you don't get it to the finish line, again, of getting that zoning approval letter, and then having that in hand to sell as the marketable security, right? Because that is essentially that you're selling in the development game, the right to develop. So we'll talk about all these step by step here, but essentially this is how you create value in real estate. Okay, so step one, sourcing development opportunities. So it's critical to learn how to identify development sites, again, based on the zoning. And the zoning will tell you if there is potential for a higher or better use. Higher meaning more density, better meaning just a more productive use on that site, right? And you can do this both off market and on market, right? So this is kind of a little graph here that kind of shows you the different methods that I use to source deals off market, right? Cold calling, right? Identifying to say that has development potential because I know the zoning on it. Zoning allows for more density than is currently on there, right? Think of gas station, but 33 units, right? That spread is the opportunity to go after. So then figuring out how to find the phone number for that owner and calling them and saying, what are you doing? Are you interested in selling? Or sending them some sort of direct mail campaign, or a direct mail came to all the development opportunities throughout an entire city, which is what I've started developing, is these lists of development opportunities, or deals on the market. And quite frankly, most of the deals that I've secured in the last kind of chapter have all been on market, right? Because what's amazing to me is that property owners don't understand zoning, just like a lot of realtors don't understand zoning, right? So if you can buy something on the market for a value based upon what's there, that's great, because the value of a development opportunity can be significantly higher. There can be a huge discrepancy between the market value of the existing asset and the residual value of the development potential. So it's a little bit complicated, but yeah. Yeah.
So obviously we can pull like a property profile, and that'll tell us the basic zoning, right? For use code. But what tool can we like?
And tell me again where you would find that?
Like pull a property profile, and it says like the zoning code.
Does it?
Usually, yeah.
Does it?
It's incorrect, typically.
Does Property Radar show zoning?
I don't know.
It does not.
I'm gonna go to the city website.
It does not.
But like if I have a property profile though, it has like use code, right?
Yeah, but
that
it's not
might
right.
not be accurate.
Okay. Yes.
My question is, from a bird's eye view, how do I, if I'm looking like in an infill project, what mapping process do you use? What is it?
Okay, so first thing you're going to do is you're going to look at the best parcel map that your city has. So you pull up the parcel map from the city itself, and the city should define for you what zone it's in. As this is the parcel map of the interactive parcel map, and Oakland has a great resource because you can literally go through and see the definitive lines, click on each parcel, and it'll tell you what zone it is. Or you can just download a PDF of the zoning map that's published by the city, which is usually a supplement plan where the city basically says, here are all the zones throughout the city, and then you got to just find where that site lays within those zones. And then once you have that, then you got to pop over to Unicode, and Unicode is probably the best resource there that has all of the, or most of the city zoning codes out there to then pull one key metric, right? How many units you can get on that site. And usually that metric, which is called residential density, is number of units per square foot of lot area, right? So you have a 10,000 square foot lot, and it says you can have 1 unit for every 100 square feet of lot area. That means that you have 100 units, right? Is that right? 100 square feet of lot area, and or let's say a 10,000 square foot lot, right? So 100 times 100, you can have 100 units on that 10,000 square foot lot. Now, that's if your zoning code is very straightforward and tells you that density. Sometimes you have to back out to the density in other ways, but that is essentially what you're looking for here. is look at the zoning code for your city and figure out how they define density, how many units you can fit onto a piece of property. That's the development potential that you're going to go after. Take it from one single family and you knock down that single family and you build 10, or you build a 10-unit multifamily, something like that. Now, so the zoning sets the development standards, right? It basically defines all the parameters for that envisioned site, how high you can go, what your setbacks are, whatever, how much parking you need, how much lot coverage. It basically all the constraints for you to draw a little picture, a little sketch, a little building that you could figure out how you could get approved. Now, that's going to be extremely important in doing the next step of finding or of analyzing the development potential. But again, your first step here is just to identify a development opportunity. And what I'm saying is development opportunity is the ability to add significant units than are currently there. Maybe not 1 to 2 or 1 to 3 or 1 to 4, but 1 to 10, 1 to 20, 1 to 100, you got something, right? There's some opportunity there. Okay, so the spread in the potential, right? What's currently there compared to potentially there, right? And it's all about potential, right? And closing that gap from potential to reality, and that's the goal as a developer. Okay, so a clear case study. Okay, this property is in Oakland. It was on the market on LoopNet, and essentially I saw it on LoopNet. It's a mixed-use building, so there was a vacant commercial space, and I immediately, as I saw it come up on the market, said, "That's in the CN3 zone." This had a 45 square foot lot. It's pretty typical in Oakland, but see square feet of lot area for every one unit. So as soon as I pulled up the parcel online, somehow, potentially. In actuality, could I get that? Maybe not. There's other constraints that have to be navigated. But I also knew that the ground floor commercial space could be converted to work-live units. Work-live units are a particular definition within the zoning code that commercial activities, basically adding an accessory element of residential space to the commercial space. So I was able to put this down the middle, over the counter approval. I did that. I bought the property. Within a month, I was within 4 months, I counter. What's beautiful is that you understand zoning and residential density. Commercial units don't go towards your residential density. So I was able to say, here, and that I can still have 10 units in the back, right? So when I looked at the aerial, I saw that there was some land back there that I could build, and the height 45, I could build up 45 feet in that back. And now I'm basically getting approvals for 6 additional units in the back, in addition to what I've already done, $1,000 of income. And I've got the development rights now secured to build an additional 6 in the back. So once I build that, I can leverage to build in the back and then refinance the whole thing when this whole thing is stabilized. What's crazy is that I bought this thing for $7. Right? You can't buy a 3-unit apartment for that. But I knew that I could get this added over the counter and essentially stabilize this asset as if I didn't get anything else, right? So my cost basis in this is probably 1.1 or 1.2 after we put about $300,000 or $400,000 into it. But that means that essentially the valuation on a capitalized basis, based upon the net operating income from this building, should be about 1.5 million. So I've already created 20% value just from phase 1. That means then the land in the back is free. I just got free land to build 6 additional units. when down the street I just sold entitled land for $85,000 a door. So I could potentially sell this site right now at 6 times 85 plus the equity that was created in the property. So by the time that we're done with this thing, I would have probably created $2 million of equity in this deal. So my loan to cost will be about 50%, and I cash out all of the investors in the deal and be left with a cash flowing asset. That's the power of understanding development. And again, this was on the market, right? This was here for everybody to see on LoopNet. Okay, so on off-market deals, again, I'm looking for locations, asset classes, and project types that I can pursue. So when it comes to locations, you can be much more specific when acting as the role of developer, right? So I'm looking at, anywhere within a quarter mile of a BART station, up and down a commercial corridor like Telegraph Avenue, within a high density or mixed use zone. So essentially, if you look at the zoning map and you can see that the mixed use zone is in a particular area, then I would say, all right, focus on that area and start to identify the sites that do not live up to their potential, right? And your opportunity then is to actualize that potential. When it comes to assets, right, I was just talking about locations, right? You can be location specific. You can also be asset specific. So I want to find vacant land. I want to find underutilized land, like my site was. There was a little building on it that I was going to tear down and build up. I want to look for existing income property with excess land. And you'll see in one of these case studies, I have essentially, I bought an existing income property with much more land and split the lot, or got approvals to build additional units around that land. I want to look for multifamily or commercial property with a major value add potential. So like an existing building that like Aaron and I are in contract on, that's just a commercial building that can be converted to a mixed use building with residential units on upstairs and commercial units on the ground floor. Or commercial income property that might be fine as it is, that maybe you buy and hold it for 10 years, but it's zoned for a high rise, right? Like there's buildings in downtown Oakland that, are fine, and they're rented up and you'll get some cash flow in the short term, but you'll have a big pop at year 10 because you get the approvals for a high rise and then you sell it as a high rise site to the next guy 10 years down the road. Crazy strategies that you can pursue in this thing. And then target projects. This is more about a contemplation of what you want to add to society, what you want to actually build eventually. Do you want to build housing? Do you want to build other boutique retail, commercial space, like office buildings or hotels? Again, this can all be small stuff. We're talking, 5 to 10 units or 20 units, like small scale incremental development. It doesn't have to be a major high rise. It's just something small that you can get excited about developing and adding to your city. You can add a bunch of interesting operators on the ground floor spaces, cafes, fitness places, health and wellness, entertainment, shopping with online sales. You can do other innovative project types like shipping container projects. Like the world opens up to you when you realize that the projects that you are trying to develop have a business plan underlying them. They generate revenue and they have expenses, and the net operating income for that property is the valuation of that project. Okay, it's not just about square footage of a house. Okay, so do you believe me, right, that this is possible? For on-market deals, you're probably thinking, I can't find good development opportunities, right? I challenge you to go on Redfin or LoopNet tonight and look at your city and see if you can find any site with development potential, right? And again, you're going to have to kind of find your zoning code and figure out where the zones are, but I challenge you to do that. I guarantee you that you'll find something. For off-market deals, you're probably thinking that seller knows the development potential of their property, right? Wrong, right? Like I said, even experienced brokers don't even understand zoning. The property owners arguably might be sitting on a gold mine and they have no idea. So you can pay them market. You can pay them what their site is worth on the market, assuming no development potential. And that could be way under what it's worth to a developer if you build that future project. Okay, step 2. How am I doing on time? I know I'm probably getting over. Okay. Step 2 analyzing potential, right? So it's critical to learn how to analyze the development potential of a site based upon the zoning code and the key financial metrics, right? I'm going to make this extremely simple. Understand to figure out what is the form that you can build, right? You got to start to exercise your little sketching skills, but start to discover your zoning code to say, all right, this is how much of the lot I can cover, right? So that's like your 2-dimension, and then think in volume, how high can you go, and then how many times can you split up that mold of clay. Think about it as a mold of clay and you're carving up the space, right? If you think about it in that sense, you can get a sense for what sort of form you can create, right? And then once you have a form in mind, you need to figure out what your projection is when it comes to yield, how much rent you can get for that residential or commercial space, right? And based upon this forming, get all the square footages that you need, right? How many, what's your average square foot for a residential unit? 1 bedrooms. You've got maybe 400 or 500 square feet. So as you take the lot that has certain dimensions, you can start to make all these little calculations, right? It's just simple math to get the mass and then to say how much space you have to rent out. As if the building was already built. How much yield can you project, right? This is like, once the project is fully complete and you've got a built building, how much gross operating income can you get out of 10 one-bedroom apartment units, all right? Then you got to figure out how much it's going to cost to get you there. How much is it going to cost to build that 10-unit building? And a lot of the times that's going to mean talking to some contractors to say, how much does it cost to build on a $1 per square foot basis, right? These are just broad brushstrokes. How much does it cost, roughly speaking, Aaron, to build a 10-unit multifamily building in this area?
Big guess, of course, price comes down, but you know, $200
a square foot, $250 a square foot. As you start to understand that there's different construction types, right? Because not all construction is created equal, right? You could have a bigger concrete podium with wood frame construction on top, like my project was. So it was type 1 construction over type 3 wood frame construction on top, because we went 6 stories instead of 5 stories. 5 stories you can build type 5 construction. So all these different construction types have different costs associated with them. So if you know that you're building a 4-story 10-unit building with a slab and wood frame construction at $200 to $250 a square foot, you can then simply compare the yield, and it's not just gross operating income, but you got to take out some expenses for property taxes, you know, the multifamily type of operating expenses, maybe 35% for a factor, and compare the net operating income to the cost. And the yield over the cost is the metric that you need to know. It's your yield on cost. That yield on cost is directly comparable to the exit cap rate. So if you look out onto the marketplace to say, what is income property selling for? What cap rate? 2% maybe? I mean, in San Francisco, threes. In Oakland, 4s, maybe out here, 5s. Right, so, and to think about cap rates as what you're willing to buy an income stream for cash. So if you bought an income stream, a net operating income stream for cash, the cap rate is essentially the cash on cash return for that income stream, right? So you pay $1 million and you get, say, you pay $1 million and you get $45,000 a year in net operating income. That would be a 4.5 cap, right? As if I put $1 million cash, I'm getting $45,000 back every year in net operating income. It's like cash on cash. That's how you think about it. You're comparing the yield on cost to the cap rate. There's a lot on this slide, but essentially this breaks down what it is that you need to understand when it comes to massing, right? Density, can you do a subdivision, height, lot coverage, setbacks, parking, open space, Basically, it helps you define exactly what you can do based upon the constraints that the zoning code defines. Word of warning, sometimes the building code requires things that the zoning code doesn't talk about, like multiple staircases or an elevator or a certain number of floors. So you have to take out of that total buildable area, you have to take out what your buildable square footage is. Yeah.
Can we count on our architects to determine that?
Please. Please. But as developers, you got to know, you got to get your pencil out and just make some of these calculations before you spend $10,000 or $5,000 with an architect to solidify it for you. So again, broad brushstrokes here. I'm not an architect. I'm not a contractor. I'm just like the aggregator of information to make a decision. Do I pursue that property or not?
Chris,
Yeah.
I mean, one of your biggest costs is still going to be entitlements.
Yes and no, and we'll talk about that.
I mean, that's a massive cost from what I've seen.
If you recall on the first slide, I spent $200,000 on the 41 unit approvals.
Yeah, but I've been working on large apartment complexes that want to charge $50,000 per door. By the time you factor sewer hookup, water hookup, environmental impact, all that.
And all of that has to flow into what is the future valuation. So you have to figure out what is your total cost. Hard cost, soft cost, buying, holding, and financing costs, and the land, right? Oftentimes the hardest thing in this business is to figure out what is a piece of land. Best approach to doing that is to back out what you can pay for that land if you need to make a certain amount of profit, right? So residual value, right? To say your future value is X and you got to have a certain profit margin out of that, and then it's going to cost you a certain amount to build that site. What can you pay for the land to still hit that return on cost? That's the exercise at hand. And essentially, you need to define what sort of return, like a 20% return on cost. I need to make a 20% profit margin or a 30% profit margin, whatever the assumption is. The other way to do it is to basically compare exit cap rate to the yield on cost, and there should be a spread. Here's a quick calculation of whether you have a deal, right? So you calculate yield, revenues and expenses, you calculate your total cost, and then you generate your yield on cost. Now, what you're really going to compare here is your yield on cost sufficiently higher than the exit cap rate, right? So if you know that the exit cap rate for a multifamily property is 4.5, you should be 5.5 or 7.5 on your yield on cost. So if you have a 100 or a 200 basis point spread between the yield on cost and the exit cap rate, you got a deal. And the way that that translates to a deal is that that's essentially your profit margin, because you would sell it at an exit cap and then you get that profit back. Other key things to think about is, again, what is your return on cost, and is your total cost, when you buy the land and you build the whole thing, can you refinance with a 70% permanent loan to get all your costs replaced? It's another way of saying you got a deal. Yeah.
When you're coming up with the exit valuation, do you only look at the exiting cap rate, or do you look at gross rent multiplier, any other kind of valuation?
Yes, for future sales of income property. When it comes to entitlements, I actually look for what is somebody willing to pay per unit for entitled land. And those are other sales comparables that you can find. So when I was getting into my development site, I knew that sales were ranging between $70,000 a door and $90,000 a door. So I had market comparables for entitled land that you can really go after and say, that one sold for that one sold for that. Now again, it's rather scattered information, like even LoopNet doesn't have, or CoStar, they don't have very good, like, this project was entitled for that and it sold for that. It'll say that piece of land sold for that, but they don't have a category, a subcategory for raw land versus entitled land. So, but that's a very easy way to project out what it's going to be worth. And that's opposed to dollar per square foot for raw land. That's an easier metric to find. Okay, so just as a quick note, and we don't have to spend a long time on this, but essentially when we were developing this 6-story building, we decided to go up 6 stories instead of 5, even though it was a higher cost to build a 6-story building with type 3 construction versus type 5 construction, because the yield on a relative basis was better to build a more expensive project. Okay, so the yield, the net operating income for a 6-story building was greater than a 5-story building. Cost was more expensive for a 6-story building versus a 5-story building. So comparing the yield on a 6-story building to the cost of a 6-story building versus the yield of a 5-story building compared to the cost of a 5-story building, the yield on cost was better for a 6-story building, even though I was going to be paying more to build that building, right? I could extract more value per dollar by building a more expensive building because of the more income that would be generated. So this is just a very clear example of how you can actually use the yield on cost as the key defining metric to say, are you willing to spend a certain amount of money if you generate a certain amount of yield on the back end? Yeah.
So did you take this through the planning committee and get approval for the concept?
Yes.
The lot, lot square footage of coverage and the rendering essentially. And so then the developer that bought it knew that there's that potential, maybe more, but I know at least I can do this.
Yes, and now you're out of the zoning department. So there's no more public process. There's no more debating. You can build that, right? So the simple fact that you're taking the uncertainty out of the process, that's the risk proposition that you're taking up front and the value that you're creating. Because you're saying now, definitively, you can build this. Screw everybody else, right? You can build this now. And people who are not local love that, right? Because they're now taking construction risk. They're not taking entitlement risk. So you're doing a great service by doing that.
Shovel ready, yeah.
No. A lot of people throw around shovel ready. Shovel ready in my mind is you have building permits, as though you can stick a shovel in the ground.
I think that's where I think that's where your issue comes in, because construction drawings and all that goes into the building permit.
That's,
Paying for that?
yes, that's in the zoning phase, to show the impacts to the local community. But shovel ready is that you actually have building permits in hand that you can start. So the project that Aaron and I are getting not only has the entitlements, but it also has building permits ready to be issued. That's shovel ready. Because the building permit process will take a decent amount of time. But yeah, jackhammer ready. but there's no longer a public approval needed or a city approval needed to say whether you can do that. I'll talk more about securing entitlements next. No, 2 steps. So for analyzing deals, you're probably thinking it's too complicated to know whether a commercial development makes financial sense, right? Like I can't, there's too many numbers. I can't figure out if there's a deal here or not. And I'm saying no, it's 2 variables, yield and cost. That's it. And you put a little slash between them, right? You divide them. And then you just compare it to what the exit cap rate is for that product, right? Multifamily, office, retail, they all have different cap rates. You just have to be sufficiently higher than that when you're building. Okay, step 3, securing development deals. It's critical to learn how to negotiate and to get these deals under contract in the right way that gives you maximum flexibility to balance the risk and the return proposition that you're faced with, okay? The biggest example that I have of this is basically getting a zoning contingency while you're in contract, right? To say that you're not going to close on the land until you've secured the entitlements. So you're going to be paying for the entitlements unsecured, but you don't have to close on the land. If you close on the land and you're taking hard money, you're taking greater risk. So you better be sure, like we were, that there was a deal here, but I was taking a greater risk by closing on the land and then entitling it, as opposed to just doing it while I'm in contract. So in this situation here, there's really, in my mind, 3 different value phases here. You either find the development opportunity and just validate that the person is interested in selling or developing their land. Call me, I'll pay you $10,000, right? If I close the deal. Just a validated lead. A property owner, again, ideally, send me deals that meet my criteria. Urban infill, transit oriented. I'm not going to do a deal out in in the middle of nowhere, right? It's got to be in the city. It's got to be close to transit. Those are all like value retainers in my mind. There's less risk associated with that. Or you go so far as to actually do the analysis yourself and get into contract. Get into contract, even if it's an LOI, on a development opportunity for a price that makes sense. And the better you can negotiate that price, and there's a huge swing. It's not like single family homes where I got $5,000. Like, you can be like, hundreds of thousands of dollars. We're talking like there's massive potential for swings in the analysis. Like, you guys are all pretty intelligent people, I can tell, and it's hard to do that analysis. A property owner, mom and pop are not going to know how you did that and come up with a good valuation. And then you can stand behind your valuation saying, nope, the yield on cost, like that's how I do my deals. And they're going to say, oh, okay. And then you assign the contract to me, right? So you assign it to somebody else while you're in contract. Or as I said, get under contract with a zoning contingency and then come to me and we will definitely do a deal. Now that requires me to get more equity because I can't necessarily encumber the land with debt because somebody else owns it still. So that's why equity becomes increasingly important on entitlement deals. Or finally, close on the deal, entitle it, and then either sell it or build the project yourself. So you either are going after finder's fees, assignment fees, or profit. Yeah?
What's the possibilities or risk of not getting that land entitled?
Usually it's not a matter of if, it's a matter of when.
Okay. So you'll get it entitled, it's just a matter of your holding costs.
Yes, unless you're asking for a variance, something outside of the rules. And we'll talk about that in the next step. I promise this is the next step. But understanding that there's different levels of approval that we're talking about here that will change the risk profile. Okay? Every city is different. Oakland, anywhere from 4 months to 12 months or plus. So it varies, again, depending upon what you're asking for. So negotiating contracts, again, you can just do a straight up sale. Try the zoning contingency. If you're dealing with property owners, just test it out. Now that means essentially that they're going to have to wait 4 months, 6 months, a year before you actually sell it to them. But what I'm telling you here is that the more flexibility that a seller gives you, the higher the price that you should be willing to pay, right? Because think about this. If you get hard money and you close on that land and you're going to accumulate, sorry, Bo, all that interest that I know you love collecting from me, I'd rather pay more to the property owner and my risk by getting into contract for a higher price if they give me that flexibility. Lending back, right? Getting, positioning yourself as somebody who knows what they're doing, and the fact that you're creating value, you're not just extracting value, or you can actually explain to them that, look, it's a good investment for them to lend back on their own property if you show them that there's a lot of value to create here. Only after you're in contract, by the way. Yeah. Don't tell them how much value that they're sitting on before you've gotten into contract. That should be obvious. Yeah.
How can you hold on to a piece of land so long without closing it?
By paying them more money.
You can have an option on it too.
Yes, or yeah, exactly. You can do options. You can say, you know what? How about I just lease the property from you, and I'll pay you monthly payments with an option to buy in a year or two.
And you got to remember, usually these properties are like properties that people don't realize there's value in it, and they're like the weird properties that people aren't looking to buy.
Yeah.
And so you have a huge advantage because like fix and flip on the MLS where there's 150 offers.
And whether you're paying that money that's applicable to the purchase price or not, it's still going to be less than if you closed on the deal with hard money. So it's an interesting way. Finally, not necessarily. It depends how you structure it, right? So there's different ways to protect yourself. And then finally, partnering with the property owner. Set a land basis. Say your property is worth this now, and whatever value that I create after I've gotten my costs back for getting the entitlements, then let's split the profits. Great way to do it. Again, these are just some important contracts that you got to know. All right, so a story of negotiating. When I was first understanding what this whole game was about, I went to my architect and was talking to them about the opportunity that I had to entitle this 41-unit project. And he said, you know what, you remind me a lot of this other young developer in Oakland that got this property under contract, got the approvals for 80 units while he was in contract, assigned the deal after the approvals, and made over $2 million by himself. Took that money, retired in Sweden.
I could probably buy a Bentley then.
I thought to myself, I thought to myself that, you know, if he could do it, why can't I do it? Right? That's a pretty powerful strategy. When he didn't take any risk in buying the deal, he just got the approvals and did it. And he's coming out of one of the top developers in the country that does this all the time. All the top developers do these strategies. I'm kind of breaking open the box here. I said, you know, I was in contract on a single family lot, and I said, why don't I do this myself? You know, this is 1/80th of the size that he was just doing, but I said, oh, why not? So I was in contract on a single family home, said, you know, there was 10 sellers, so I had to get approval from all those 10 sellers to allow me to get the zoning approval before I closed on it. I used credit cards to cover the costs associated with the plans from the architect and the city fees and the surveyor. And in 4 months, I got a regular design review approved for one single family home, assigned it to a builder for $50,000. I signed it. I didn't close on this. Got into contract on a single family home site, paid for the approvals, paid for the plans, assigned it, cashed out. So I basically, I spent $25K on this and made $50K. So again, I just wanted to concept that, you know, hey, look, you can do this on this scale or you can do it on a massive scale. All right, so do you believe me? Yet. You're probably thinking it's too risky to pursue development deals, right? And as I've shown you, you can put flexibility into your contracts, especially if you're sourcing stuff off market. On the market, it's going to be really tough to get somebody to say, can you give me a year to get the approvals? But if someone hasn't been thinking that they are going to sell, or they're operating a business they've got an auto body shop. One of my students has an auto body shop, and they're just humming away, making good cash flow from their auto body shop, but they're sitting on a site with 100-unit potential, right? So it's no skin off their back if they give me a year to approve it, or they approve it themselves. It's just kind of their regular course of business for them while you get the approvals, and then you close on it after that, and then they shut down their business and move elsewhere. So interesting. Step 4, finance development projects. So as I said, you do need to think about, in any deal, debt and equity, right? Most of the time, debt is talked about, but the equity side becomes really, really important to try and figure out how to solve, especially when you have potentially low leverage, right? Raw land, if you close on it, maybe you only get 50% of the acquisition price. That's basically what we got on our development site. 50% loan to value. So where's the other 50% coming from for the purchase and the entitlement costs? Equity. So I raised $900,000 of equity to do that deal with 2 other partners. We each contributed $300,000 of that equity, and then we split up the profits on the back end. So, you know, figuring out ways to either get third-party equity, where they're not taking any liability, they're not guaranteeing loans, right? They're just putting money in, coming into the operating agreement with you for a preferred return on their money is an important thing to consider. They're not taking guarantee risk, they're not guaranteeing the loan, so their risk profile is less. But the third-party equity can act like junior debt, but not actually be secured with a deed of trust. They're coming into the operating agreement with you as preferred equity investors. Or you bring in joint venture partners that you actually need to partner with, like Aaron and I are doing a deal, right? We're both guarantors. And actually, Aaron and I's example would be more sponsor equity. We're sponsoring the deal, we're guaranteeing the loan, we're taking an active role in developing the project. The partner equity can be kind of a hybrid. You can either get a joint venture partner in, especially if they're less than 20% ownership of the LLC, and not require a guarantee. A lender would not require them to guarantee the loan. But you can still give them a slice of the pie to boost their return because they're taking on some risk. They're taking on higher risk as opposed to if they were just debt. Yeah.
So do you have, do you have a list of contacts or guarantors that are comfortable, serving as guarantors?
No. There's a so there is a market for balance sheet support, right? Some tech guy who's worth $1 billion doesn't have much cash to his name would be a perfect candidate. They are worth $1 billion, but net worth and cash are very different, right? If they haven't cashed out any of their stock, they're worth a whole lot of money, but they don't got anything in the bank. So that's a perfect partner. It's a perfect partner to get big construction loans, right? Like I couldn't build that 40-unit project because I needed a $10 million balance sheet to get a $10 million construction loan. Oftentimes lenders want to see that you've got net worth and liquidity correlated to the size of the loan.
The second one is when you're pulling together the capital, are you putting out a private placement memorandum to get with that?
Yes. If they are passive investors. Active investors, you can just get away with an operating agreement because they're actually playing an active role where you're both managers and members.
That's JV.
That's more of a JV versus a syndication, which would look more like third-party equity or partner equity for minority stakes. Little esoteric, more esoteric. Sorry about the slide. There's a number of deals that you can do, whether it's a deal that you do by yourself. You can do a TIC deal where you all own shares of interest in the property itself. This would be conducive to a 1031 exchange where everybody has to own direct ownership of the asset and not have it all merged together in a partnership entity, a joint venture. And a joint venture would be more of like an LLC where you've got managers or managing members. Or you do some sort of syndication deal where you're basically using something like a limited partnership to raise passive equity from limited partners, and you play the general partner role. We actually deployed, all three of these, right? So we had a project company, 657 LLC. Then we had my development manager, and then I had my investment entity. So we had seven entities involved in this partnership because we each had our manager and our member, and we had the project company. So it kind of looked like a star, but it was for asset protection. For equity, just keep in mind, and I'm throwing out a lot here, cash in the deal can be disproportionate to stake in the deal. And that's what you're selling. If you need $200, right, you can sell $100 for a third of the project or a third of the deal, right? And you can do that with the other guy, and he gets a third, and then you get to keep the other third. So they're putting in $100 and they're getting a third of the deal, right? So if the profit is $100, they get $33 in return of their $100, right? So they're making a 33% return on their money. It's a pretty good return. I didn't put anything in the deal, but I kept a third of the deal. So understanding how to structure equity in this straightforward fashion, which would be option one, just a straight split, keep it simple, great. Or you can get a little bit more convoluted with a waterfall structure where you can disproportionately benefit the managers running the deal as opposed to the investors who are owning or investing in the deal. Depending upon how profitable the project becomes, the managers get paid more of the profits. Interesting way to kind of give the money priority, but give the managers the upside. Case study, okay? Another example of a deal, this was also in Oakland that we closed last year. It was a single family home with a storefront to it. I understood that I could, in the RM4 zone, split up the single family into 2 units and build another 2 units in the back, or entitle it to build 2 more units in the back and convert the existing storefront to a work-live unit. So I was able to get 5 units approved here and sell it as a condo project to the next guy, meaning he had to pay me more, or he had to pay more because my cost basis was too high to justify this as an income property, a 5-unit income property. So I told him, and I sold it as, you can sell these individual units for significant value because it was in a very attractive area that could get their kids into a good school district. So the way that we had structured the financing on this deal is that we took on 100% debt. We did that by using a private money lender behind a hard money lender, and it was really my partners who brought me that private lender that was willing to do that. And I gave them 50% of the equity for bringing that money, even though it wasn't any of their money. So those guys got 50% of the equity for just bringing the other private lender to the table to cover the rest of the purchase price and the entitlement budget. So again, we just sold this site as an approved project for a 5-unit condo project. We made about $400,000 in 9 months. So when you ask about zoning approvals, and it's 9 months after getting the zoning approval for it. I actually lived in this property while we were getting the approvals for it for free with my family. So there's other benefits when you're not touching the asset, is that you can take advantage and you can use it in the meantime. Okay, so do you believe me yet? No. You're probably thinking it's too costly and not clear how much entitlements will be, right? And I'm saying, well, no, because you can actually lock down your budget for the entitlements almost 100% certainty up front. Your architect will give you a bid, your surveyor, your environmental consultant, the city, everybody will give you their bids up front. You'll know exactly how much you'll pay. And compared to what it costs you to actually renovate or construct a property, it's a fraction of the cost, right? Yes, you might be spending $200,000 on the approval, but it's going to cost you $12 million to build the thing. So the relative return on the investment is a lot higher in the entitlement space. Okay, last step, managing the development process. So you've navigated the whole process, you identified the site, you determined its potential, you got it under contract, you now actually got it financed and you're going to do the deal and you're going to manage the entitlement. Great. It's critical to learn how to manage the process and the professionals involved, right? Because your team becomes, you as a developer, it's like all your subcontractors if you're a general contractor, right? These are all the people that are going to be part of your team. You're going to have the architects, the engineers, all the traffic consultants and the acoustical consultants and everybody else, the MEP everybody that you need to have involved in the process. They're all going to be your team members and you're just the orchestrator, right? You don't have to know how to do any of that. You just know how to find the right people, pay them their money, assemble the deal together, and maybe even just pay somebody like an owner's rep or a development manager to run the deal for you. So you can just sit up on high once you've closed the deal and watch everything happen because you've hired somebody for a monthly fee. And I'm even considering doing fee development, as many developers do, as additional cash flow. Now, on the process, right, you need to navigate this initial process first. So let's look at that. Navigating the city, or specifically the zoning department. You get the zoning department and the building department. We're not going to touch too much on the building department, but the zoning department here, you have to understand what type of permits, zoning permits, you need to get. What type of design review are you going to have to go through? If it's new construction, more than likely you're going to have to go through a regular design review. But sometimes when you're only adding a certain amount of square footage or you're converting a site, again, it all depends on your local city, but oftentimes there's expedited design reviews like in Oakland. Use permits. Is it a minor use or is it a major use? And the zoning code will tell you when it triggers that next level of use permit. The use permit is correlated to who actually has to approve it, right? So depending upon the type of use that you're getting, it might be something where you don't need a use permit. You can just do it, and then you can get over-the-counter approval. Like on my the work-live unit conversions, I don't think I needed any sort of use permit. Maybe I did, but it must have been minor because it was over-the-counter. Fifth Street was another example of that. Yeah. Planning administration, though, this is like, these are the people who sit at the zoning counter. So I would suggest everybody go to your city and go and talk to whoever's sitting at the zoning counter and just tell them, look, I've got this site. Tell me what I can do with it. That's basically what I did. I just went to the zoning, picking their brains about what zoning was all about. Planning administration is like everybody who works in the planning department, including the planning manager, that you can stay in an administrative approval process. So this point here is extremely important because in here, the planning administration, these are all the people who have been hired by the city to grant approvals because of their background, right, their qualifications. This might not require any sort of public process, public notification or public hearing. Those are two different things. You are either notifying the public that you're going to be doing this, or you actually have to go to a public hearing, which would be like the planning commission or the city council. So if you're getting, say, a major use permit, you might have to then go to the planning commission and speak in front of everybody. And it's an open forum of people who have been selected because of their knowledge to approve projects. But if you're asking for something like a variance, variances are usually correlated with the city council. The city council will not get involved typically unless there's some sort of exception to the rule, right? The city council is only involved if you're asking for some sort of zoning change, right? If you're by right, you're going to be rezoning it and asking for an exception. So there's numerous implications to going up and down this hierarchy, whether you're going to get approved or how long it's going to take to get approved, who you have to notify. The more people that you have to notify, the riskier it's going to be. Same thing with costs, right? All of these are risk factors. They increase the riskiness of the proposition that you're pursuing. So you just have to basically figure out what the path to the approval is. And I can only know my city, right? I can start to get to know other cities, but the power that you bring from your local city is how to actually get this kind of stuff approved. And you can position yourself as a local expert to say, I know how to navigate this. I can do this. I have the inside connections. Okay, story of outsourcing. In that development partnership, I partnered with a guy named Carlos, who runs a company called BuildZig, and he basically does entitlement management as a service. He'll basically run the approval processes for larger scale developers, like a high-rise developer, or in our case, our development company. So he basically had his whole staff of people managing the entitlements, coordinating all the bids and getting all the approvals necessary and getting into the city, scheduling, and providing us these weekly reports. And so I, as the developer, wasn't doing much in this process, right? I was basically getting weekly notifications and making decisions after the management team was telling me what progress that they had made. I was also responsible for doing all the financial, logic behind the decisions, but for the most part, it was kind of an outsourced opportunity. So this is a great thing for you to realize. This was another project in West Oakland that we ended up doing, sold last year. This was split. So as I said, one of the project types that we look for is income property that has excess land. So essentially, because of the zoning, which was RM2, which is pretty low density, we were still able to split this lot. And a subdivision is a completely different parallel process compared to the entitlements. I didn't quite internalize that when I got into this deal. So as you see here, the time frame took a little bit longer because not only did we have to get the entitlements, but then we had to get the subdivision approved with the county, because the county had to basically issue a new APN number. So I had to manage this whole process. It took a lot of time and energy. We only made $400,000 on the deal in the 22 months, but got a ton of experience out of this deal, and it was super creative because essentially we did a value add upgrade on this mixed use 4-unit building. We split the lot, we demolished the other 5th unit that was attached to this building, then got approvals for these 3 new units, but we planned them out as a co-living project. We essentially found an operator, a co-living operator, that would rent out every single bedroom in these 3 single-family homes, essentially. And we got it approved as that, too. So this operator was going to basically rent out 16 bedrooms and operate an integrated community where all of these people who were living in here would all come down to this structure and gather together and have meals together. And yet they would all live in their individual bedrooms. So it was an interesting way to basically get a lot of yield on a low cost of construction and more density in a lower density zone that didn't actually allow for 16 units. This zone only allowed for 3 units, but we were able to max out the bedroom count in order to potentially generate a lot of revenue from each one of those individual bedrooms, which would be much higher than just renting out individual single-family homes for rent. So pretty interesting process. I had to navigate this whole thing, and we should have made a lot more money because I wanted to actually build these, but I had a partnership split that didn't quite work out, and we went all the way to shovel ready with this one. So I was very close to building this thing, and we spent a lot of money on the building permits when I would say we probably should not have if the plan was to exit just after the entitlements, because you're not really getting much of that money back by way of a return. Okay, so do you believe me now? You're probably thinking this is going to take you a lot of time and energy, right? And I'm saying, well, no, because the work is primarily done up front. It takes a lot to get the deal done, but if you assemble the right team of people, it should, for the most part, the entitlement process, not the construction process, the entitlement process should operate relatively smoothly because you can manage it remotely from your computer and just tell the architect to go and deliver the latest set of plans to the city. And you're probably thinking that it's going to become a full-time job for you, right? And I'm going to say absolutely not. And the amount of time that I spend on creating value through entitlements is so much less than being on site on a construction site and making sure that every single day the progress is happening. So you can actually leverage your time a lot more effectively this way. Whew. All right. So, yeah. That was a lot. Well, not yet. All right, so 5 steps. If you can identify a property with development potential, if you can then analyze to make sure that that deal makes sense for the price that you can get it for, and then you lock it up with a good amount of flexibility, ideally off market, and you get that zoning contingency, and then you get enough money together to get the entitlements, right? Maybe if you get the zoning contingency and you put $100,000 into it to get the approvals, and then you sell it, right, after you've effectively navigated the process, do you think you can make some decent money doing this?
So Chris, one question.
I would hope so.
So I just went through this whole process, and one of the sticking points right now is with the fires in Santa Rosa. The cost of construction has gone through the roof, and contractors are quoting huge per square foot rates. And then a lot of cities now are saying you have to pay prevailing wages. So how do you navigate the cost of construction and prevailing wages?
Yield on cost. If the city's going to make me do prevailing wages, meaning you're going to have to pay labor union prices, as long as the yield on cost makes sense, maybe I have to charge more for the tenants on the back end. Or maybe I'm going to have to pay less for the land because of that. Right? So if the landowner says, that's my price, and I'm going to say, the city's going to make me pay prevailing wages, it's going to cost me a lot to build on this site, you got to come down on price, or we're not going to do a deal. it's a constant balancing act between yield on cost. So again, the financial analysis to this, and maybe you're going to take slightly less return. Maybe that's the thing that's got to give, right? So it's like one thing's got to give. Either the deal's going to get done or not. And as far as what happens if a whole city burns, and you get flooded with developers, and the city says, "We got to rebuild, open the doors, open the floodgates, get things approved," the cost of entitlements will go down, right? Because theoretically the city's now opened their gates, and there's a lot more projects going through, and you can find anything to build, right? So there is risk in this, right? Same thing with the market. If it's just a piece of land, there's nothing retaining the value, right? So land is the most volatile asset class in all of real estate, right? Because it's got nothing, it's just dirt and a piece of paper for the entitlements, right? So it's theoretical value, but it's real value. It's actually real, and it's critical because it actually defines the vision, and it gets the approvals that you need to build it. Okay, so can I spend the last few minutes here just talking about this developer academy that I've created that can basically explain this whole process to you in more legitimate terms? It'd be really quick. All right, so the developer academy, I basically created this whole 8-week program for building wealth and creating impact with real estate development. So essentially, this stuff is not, for everybody, right? Ideally, you have some measure of real estate experience, right? Because these are slightly more advanced strategies that we're talking about here. But if you have any measure of real estate experience, whether you're a fix and flipper, if you're a professional, like an architect, or if you're an agent or a broker, or if you work for another developer, this type of training is critical, because the way that I've assembled this whole program is that it's closing a lot of gaps for people in their understanding to how to create value. People aren't taught how to do this. So we've got basically 8 weekly sessions in this program. It's all online, okay? So these are all pre-recorded webinars with PowerPoint presentations with a ton of detail to them. So we talk about the vision of smart growth development, getting you to understand what the whole vision is here, how to capitalize on real estate development, so understanding the risk and the return across the board, all of those parameters, how to market for development opportunities, again, like sourcing deals both on and off market, how to analyze the development potential, which basically goes deeper into how to look at the yield on cost and all the other financial metrics like comp analysis for this type of work. Negotiating deals and assigning contracts and how to actually effectively navigate that. Structuring deals with finance and managing projects. So all those little diagrams that I was pointing onto the board, there's like whole slides on each one of those deal structures, for example. Securing and selling the development rights from the city. So again, more elaboration on what it actually takes to navigate the city. And then how to actually look towards construction. So this whole program is really designed to, again, give you the initial understanding of how to navigate the entitlement process. And basically, if you get a larger scale development, how to actually think about partnering or raising the money, getting balance sheet support that you need to build that dream that you have. So, we also go into a lot of the construction fundamentals that I've had to internalize just to make sure that I'm actually approving the right type of project that's going to get built eventually, even though I don't have that sort of massive construction experience yet. Last year I had basically my entire development live event that I did with the first cohort of everybody that went through this developer academy. So I had about 30 people in the room with my entire team. So we had 3 of the top architects in the East Bay come that I've worked with them all, and all these panel discussions were me playing kind of the archetypical new developer, asking them all the questions that you would have if you were to start this process. So I've really expedited a lot of the questioning that you need to ask in order to understand, from the civil engineer, the structural engineer, and the environmental engineer, a mid-sized general contractor, the owner's representative, one of my land use attorneys, my surveyor. This subdivisions panel alone will open your eyes to so many ways to create value in real estate. Structuring, so I had my CPA and my attorney. Financing, so I had different types of financiers. Marketing, different commercial brokers that specialize in each of the main asset classes, multifamily, office and retail. And then we even had a city official come to talk about the zoning process, and my partner who runs the entitlement management group to understand how to actually secure entitlements. The key resources that I provide in this program, the main one being the financial model. So I've come up with a financial model that basically defines all these different strategies as we've talked about through that roadmap, and gives you basically all the analysis to come up with, for example, the residual land values. Like, what is the purchase price that you're going to be able to offer to these property owners given the development potential. So it's a really, I mean, I have a financial modeling background, so that alone is worth a lot of money because it takes a lot. Even I have trouble coming up with these values. Marketing campaigns, so direct mail campaigns that you can actually send out to folks to actually source these development opportunities, explaining to them the opportunity that they have, and the legal contracts. So I've got, I had my attorney draw up a letter of intent, a purchase and sale agreement, an assignment agreement, a joint venture agreement, all these agreements that you need to use to essentially get into contract with these development opportunities. I had done a fundamentals program previously. This was a 5-part module on the key elements of this business model. When it comes to strategy and structuring, those 2 modules alone go into a lot of depth of how I've structured my entire life. Right, both like my life in terms of the trust that I've created, all of the entities and all the sub-deal entities. So, life, company, and deal structuring. There's a lot in there that I've spent thousands of dollars with, people that Fortune Builders had connected me with, and understanding how to do all that. And then the core process of acquisitions, financing, and development. Case studies, this has been a painstaking process, but I've put hour-long case studies on every single one of these deals that I've done, detailing out all the documents that I've had to obtain to get the approvals, and basically doing a very kind of open kimono session on the numbers associated with these deals and how they were sourced and the resulting figures. So this has been painstaking, but I've almost got it all done. There's a private development group that we have. So I've had about 50 students go through this program thus far, and everyone's been pretty active on the development community site, which is a private Facebook group. This has probably been the best thing for me to do because I can be very transparent about the deals that I'm doing, and I can just post about opportunities that I'm pursuing in the market that I wouldn't want posted on social media, right? So it becomes a really kind of a nice way to have some curtain where I feel like I can share it with other people who are pursuing similar deals without being too exposed to the market. I've been doing weekly coaching calls with my whole student base. This is only going to run through the end of May, partly because I'm going on paternity leave, my own company's paternity leave. I don't have any employees, by the way, so this is all one-man band. These weekly coaching calls will continue to happen. They're every Wednesday at noon. These have been hugely clarifying for me just to kind of continue to elaborate on all this stuff and then answer any questions that people have. Okay, so there's a whole bunch here. Easily $20,000 worth of value for all this content. I'm only offering this at $1,500 through to next month, May 12th. Part of this $1,500 studies, one of my best friends thus far made $600K on one of his first deals. This was just the past 6 months. He got, and he simply had a site that had development potential and assigned it to another builder who was going to build 11 homes in Hayward, and he made $600K on that deal. Oliver's he worked for one of the largest developers in the Bay Area, jumped ship in his own company, and we just closed our first deal, and he made $50K from that. So 30-day money-back guarantee. This is what I was alluding to. I have a live event coming up in May 12th. So it's going to be a day long in Oakland at Spur, which is a really good nonprofit group that focuses on the development of cities. This is in downtown Oakland. I'm going to have about 100 people at this event, and I'm going to go through the step-by-step systems and processes that I've put in place. So it's even further granular detail on exactly how to go step-by-step and actually pull all the parcel maps and do all the analysis. You get 2 free tickets to this. So for that $1,500, you get yourself and somebody else to also come to the event for free. So that's it. The Smart Growth Developer, www.smartgrowthdeveloperacademy.com. It's kind of a long URL, but I would love it if people would join this. I promise you, again, that 30-day money-back guarantee. There's so much value in this thing. This thing is not worth $1,500. I've spent so many hours putting my life and my life's work over the past 3 years into this thing. So www.smartgrowthdeveloperacademy.com. I'd love to have you, and hope to see you at the live event on May 12th.
Chris, that was good. That was pretty awesome. Anyway, anybody have any quick questions? Diva.
Oh, I'm having a boy this time. It's my second child.
Congratulations.
Thank you. Yeah, so one and done.
Real estate questions. I'm just kidding.
Human
I'm
questions too.
kidding. No, it's important. It's important.
And just on an interesting story side note about that, I took my paternity leave the first time around to start this company. So I didn't spend enough time with my family the first time around. So now it's like I've finally gotten some freedom to be able to actually take that time. Yeah.
Anybody have any questions? Well, thank you very much. I got a lot of value out of your presentation, which I knew I was going to anyways.
Thanks, Bo.
And it's great to see you evolve into such a wonderful person.
Boom.
Anyways, I don't know who's speaking next meetup in June. We have Michael Morangello, however you say his name, from Bay Area Wealth Builders. He's going to put on some presentation for us next month. Who should we get? What do we want to hear about? Who would be a good speaker? Grant Cardone. Let me show you the picture of me and Grant. You want to see it?
Good luck with that.
Yeah, we could probably get Grant. I went to his 10X event. That was really fun.
How much did he make on that event?
He made, we calculated, he made about 20 million. Yeah. So, do you guys know, ClickFunnels?
Yeah.
So, ClickFunnels, if you guys don't know, is like this guy, Russell Bronson, created, and it's a software where you create a funnel to sell a product online. Anyway, so Russell Bronson was there, and he's like 30. He sold $4 million in product off the stage because there's 9,000 people at this event. $4 million.
No. 30 million.
No.
He sold $30 million on stage.
No, I think it was only $4 million.
I'm pretty sure
at
that
10X?
I've seen some sort of post.
Well, anyways, even if it's $4 million,
30 million, 30 million
minutes
in 90 minutes.
Yeah, it was pretty.
I'm pretty sure we can check on that. But
Was that Brunson?
that was Russell Brunson,
Yeah,
and then that's how Grant I think made the majority of his money because he got a share of that.
So yeah, Grant sold. He had 9,000 people there, and everybody paid probably at least $700 a ticket, 600, whatever. So I mean, some people that sat in front were paying $15,000 for a ticket. It's really good. I mean, it definitely is really good. I mean, the bottom line, my takeaway from that was just, you got to take massive action and get out there and do it. I mean,
network.
I mean, we can learn all this shit, and
my life's work.
No. I mean, good shit. But if we don't actually act on this, if we don't look at deals, we're never gonna find a deal, right? I tell Eric that all the time over there, right? You gotta look at. If he wants to buy multifamily properties. We got to look at multifamily. We got to run it through the process.
Totally.
But now,
and I really hope. I mean, again, there's some very simple stuff. Pull the zoning map from your city. Understand the residential density for those different zones for that city, and just start looking around. Like you're driving around, it's like, oh, development site. Oh, look at that guy building that. Like maybe I should find out who's that builder, and I can sell him the next deal. Like,
and also like if you're interested in multifamily and like there's a huge lot and everybody's looking at the actual numbers and like, hey, what if I, raise the rents up? What is it going to be? Well, what is it going to be if you could build another 20 or 50 units, right?
Totally.
Like that's like the things we have to think about.
And those sort of hybrid deals, I would say, are the best way to get involved with development. You find something that has some income on it already, but more development potential that is just icing on the cake. Right, so you're not taking on too much risk by just finding raw land.
So somebody new or newer, like maybe they've done some real estate deals. Yeah, I mean, you're basically it's more of like a value add type deal where it's as opposed to maybe like a piece of dirt.
Yeah,
unless it's like a simple lot
or
split.
you can do value add plus an opportunistic development. It's got 2 phases of strategies to go after. So, yeah.
I have a question. Why do you think it is that like the company that bought the 41 unit property off you,
Yeah.
that's going to do low-income housing?
Yep.
Why are they not looking at deals like this? That is their business.
Mm-hmm.
They're still not looking for properties or a piece of the land like that. They're paying you after 6 or 9 or 12 months.
Because they're
Just deliver it.
Well, they're out of San Diego, so they don't know the Oakland process.
Okay.
But they know that there's a lot of affordable housing money, percolating around within the city and the county
that's-
that they can tap into. Right.
So it therefore takes understanding the city and the process for funding on
Financing affordable housing,
And-
tax credits, and all that kind of stuff.
And also, I mean, how many times have you paid a wholesaler $100 or $50 or $25,000, right? I mean, everybody pays somebody.
Yeah.
Everybody pays somebody one way or the other. Yeah.
Yeah.
Chris, where are you finding, so like, let's say you're a buyer out of San Diego, are you just putting it on market, in marketing, or?
Yeah, I worked with CBRE.
Yeah.
So working with these top brokerage firms, like, you get your money's worth because they've got buyers list of developers.
Yeah.
And they've got national buyers lists. And again, that's the beauty of entitlements, is you can be the small guy on the ground that knows the city and throw up the approval process, especially if it's 100 units. Like that's a tall order, but institutional level money, there's so much institutional money that's just needing something of scale. And these institutional developers who have these institutional relationships need something with enough units, like 100+ units, to plunk down $50 million. They need that because they've got too much money and not enough good deals to go around. But there's also a lot of opportunity on the small scale stuff too, where the contractor down the road who knows how to build a single family home is ready to do 10 townhomes.
So is there a sweet spot there of the number of units? Or is it just?
There's actually kind of a no man's land. There's like a no man's land, right? So it's like you've got the guys who know how to build single family homes, and then it kind of drops down. Because once you've gotten the experience to build 10 multifamily units, now you can do 50 and 100. You're not going to go back to doing 10. So there's a really kind of small, there's a deep chasm of players, right? So if you can play in that space, and that's kind of ultimately the vision that I have, is empowering 1,000 developers that all are going to do 10-unit deals, ground up, and then partnering with them in some way and raising an equity fund to invest in their deals. And then get Bo to give Bo to give the debt. Close to Bart? Sure.
What? So you own a lot in San Leandro, or you have one under your radar, or what's going on?
Yeah, I got an off-market lot zoned for 9 units.
Townhomes? Like what do you see?
Zoned commercial.
What do you see on it?
What do I see?
What is appropriate? What should be there?
After hearing you talk, I've already been to the city. I've talked with, there used to be a gas station and a laundromat. Talked to water. They don't want to do any testing.
Okay, so it might be dirty.
They're done. There's no testing required. They don't
Oh,
want to do wells.
so they've done a phase 1. They've done a phase 2.
It doesn't exist.
What doesn't exist?
No, you have to do a phase 1 when you're yeah.
It's $2,000 to do a phase 1. Always do a phase 1.
Yes.
That basically tells you the historical use of the site. If that person who's doing all the research says you just said like the 2 death words in land development, laundromat and gas station, right? So they're going to say you have to do a phase 2. Phase 2 will cost you maybe $12,000. I've done this so many times at this point. I've drilled down into the earth and you extract out a core sample and you go all the way down to the water table.
It's almost like a soil report.
It's a soils report that then tests the not consistency, the composition. That's the soils report, is the composition, the cleanliness, really, the cleanliness of the soil, any remaining lead content or gasoline content.
How deep you have to go and remove all this stuff.
And in a phase 3, and the groundwater, if that's contaminated, and they'll also test to see if there's any vapors coming up from the soil. So if any of that comes back as below or above the threshold for residential development, then they're going to require a phase 3, which means coming in and starting to excavate and clean dirt.
Right. So
Don't clean dirt.
The city and East Bay Mud say it's fine. They're not requiring any
No further action.
no action.
Okay, so you do have a phase 1 and a phase 2 with a no further action letter.
Okay.
That's what you want.
No, I think what he's saying
That's
is,
what you want.
yeah, I don't think there is a phase 1 or phase 2, but I think, you know, if you get like,
There's a historical record.
but lenders,
Okay.
but
say
lenders
that it's
want
clean.
phase 1.
Warning, don't do the phase 2. Don't do the phase 2. If you get the reports back and it's really bad, the state can come after you and make you do the remediation.
Right.
But you're in contract, right? You don't own it.
No, he doesn't even have it in contract. Get it in contract.
I own the property next door, and I
Got it.
the lot is
Can you get a zoning contingency?
you can put 9 units on it with its current density.
But can you get them to
Yeah, so
give
what-
you the flexibility while you're in contract to get the approval?
Yes. Write an offer with the
do it.
zoning contingency. Like,
Then call me.
hey, call me first. I'll broker the deal. That's good. I know where the property is.
But
actually.
seriously, like those are the key main things.
I'm not saying anything.
Is it clean, and can you get the flexibility? If it's raw land, those are the first questions I'm going to ask.
Yes and yes.
This is fun.
I was going to ask you on when you said you took a gas station over on the garden. So that was my first question when you said gas station.
And I was in contract on the deal, and I got a radar detector out there. I mean, not me pushing the lawnmower, but a radar detecting company, because there was no sign that they had taken out the underground storage tanks.
Yeah.
So in addition to that, I then also hired the soil company to basically do the drilling. But I'm putting the case study together on this deal, and the way that I navigated that was basically to push it onto the seller. So he hadn't done a phase 1. So I had him pay for the phase 1, and then I said, if the phase 2 comes back dirty, you have to reimburse me for it. So, I'll pay for the phase 1, but if it's dirty, you got to pay me back before I get out of contract.
And then they're screwed anyways because they know it's dirty.
Right.
And they got to disclose
and now
it.
they got to disclose it, so maybe they'll come down on price. But, that's a tricky world because, taking dirt and either cleaning it or excavating it out, the most expensive thing in construction is moving dirt, is it not?
Yes.
Excavating and moving dirt.
It's between brick, concrete, and dirt. Dirt is the most expensive one to dispose because you cannot
Yeah.
recycle wool.
I think it's lunch.
Dirt and brick.
Lunches?
Concrete is the cheapest one.
Yeah.
Because it's funny because I know I'm going off tracky, but it's funny because when we get to a project, we break all the concrete, then we pay to dump all the concrete, and then we send our trucks back to buy back from them because now, became like base rock, so we use that base and to build roads or whatever. So it's that process is funny because you pay to dump and then you go back and you buy back from them.
It's a good business. If anybody has a good, valley that you can fill up and then develop on the land, and then you, in the meantime, just receive dirt from people, I think that's a great business model.
Hey guys, I don't want to cut you off, but they're cleaning up outside.
Cool.
So we'll have Chris back if he enjoyed us enough to come back one of these
and
days.
something other than this, but maybe something deeper.
Yeah.
Or a case study or something like that.
Maybe we'll do a little keto first too.
Yeah, we can do that too.
Okay.
Throw Bo around.
Yeah. I know jujitsu though.
Ah.
Yeah.
Once I hit the ground, I'm done.
Yeah. See. But I want to be able to do one of those cool wrist locks. where,
Yeah.
And I like the outfits.
Yeah, with the hakama.
Yeah.
Cool. Thanks
Well,
again, Bo.
Thank you for coming. It was awesome. And thank you guys for coming. So anyways, guys, I'll email this link out for you if you want, or just take a
Thank
picture
you,
of
sir.
it.
Thanks.
Sign up if you're interested in
A lot
developing
there.
real estate.